Hello to everyone on the call. I'm sure looking forward to the days when we can do this again in person and everybody can have a sandwich or wrap or salad or something in front of them while we're talking about the markets. But we're having a lot of success with the Zoom call, and as Bill mentioned, this is our third effort to do this, and we continue to have a pretty large number of folks show up. I think we've got 35 attendees at the moment. So obviously a lot of interest in things that are going on. And I think that this presentation already touched on current events pretty well. Obviously there's new news since we first put this together just a few days ago. We'll hit that as well. But we're going to get started with the market recap of things that have already happened with data that goes through the third quarter. And there's going to be multiple parts of that. We're going to step through all these different parts of the market and then move to the second part of the presentation where we talk about what's coming. So let's go ahead and kick off the market recap. And we're going to start again with this headline that is obvious here, that the risk on rally continues. So when we're looking at the last 3 months that you see there, again, ending September 30th, the global equity index was up over 8%. Now, the U.S. markets led the way there in big picture terms, but that's a year's worth of return. So terrific quarter. Now, it does just get a slightly positive year to date, but if you take a 1 year perspective or trailing 12 months, as we often call it in some of our charts, you'll see that for 1 year, we're up nearly 10%. So all of the spring downturn in the market has just about disappeared from the tables of returns that we show. I think we'll probably remember it for a longer time, but the markets have recovered. If you look at the fixed income index for 3 months, up 0.62%, year to date up 6.79%. The fixed income market keeps surprising me in that yields keep falling lower and lower. There does have to be an end to that, and maybe we're at that end now. As we go forward with yields this low, it's not looking great, but we'll get into that a little bit as well. But it's hard to find the bad news in the chart of historical returns. We may all feel our scars, but the market has recovered, so now we can move forward. As we just remind ourselves of the past 12 months, there's the big dip in the spring. And, you know, it's always easy when you're recovered from that to look back and say, I hope I took my profits along the way in the run-up. I hope I bought stocks when things dipped and took advantage of that. It's a little bit harder to do in the heat of the moment, and I guess that's one of the values that an advisor brings to the table, as long as we can stick to our plan for each of you and actually buy on the dips. If you look at the 3 headlines that I've highlighted there over the last 12 months, I've highlighted the 3 that I think are the most important. You know, it's the red one at the beginning. That's no big surprise to anybody. New virus discovered by Chinese scientists investigating a pneumonia outbreak. And the markets did not decline right away. We were talking about this in January in our annual market report when so many of you were able to get together in person. But the market figured it out relatively quickly and absolutely plummeted. The green headline at the bottom of the V there is action by the Federal Reserve. And there were 2 phrases that they used that I don't think I've ever heard before. And it was exactly what the market wanted to hear. They pledged to do whatever it takes, with infinite money. I think it was the infinite money one that really threw me for a loop there. Market loved it, started marching back upwards. But then actually it's the next green headline that I'm going to talk about a little bit more today. Fed eases inflation target in landmark decision. And really what happened there, and I think this is the foundation for the market moving upward potentially for years to come, is the Fed looked at its 3 mandates and said, look, we're going to only worry about one of them. I'm going to get into this a little bit later. We're just going to keep our foot on the gas for the foreseeable future. And so the market is pricing based on that promise right now, and I think will for years to come. If you look at this most recent 12 months of volatility, it does register on the scale that insert there is the last couple of years of volatility. So it's not going to disappear from the charts the way so many of these little bits of news do when you take the longer perspective. On the next slide, I do want to remind you of what I was talking about 1 year ago, and it's eerily similar. We were having some chop in the market, and 1 year ago, in the fourth quarter market report from 2019, I was telling the story about how we'd had a market dip a few quarters ago, how we'd taken profits from people's equity allocations along the way. Then we had a big market dip. We stepped in and bought, and then the market recovered. So I was just reminded as I was preparing this quarter's market report that this sounded a little bit similar to what we had talked about 1 year before. And in fact, it was action by the Federal Reserve that caused the markets to recover. You may recall that the Fed was in a tightening cycle. It had been raising rates, and the markets didn't like that. And the Fed said, okay, we'll stop doing that. We'll go the other direction and we'll lower rates. And so the market loved that. And so the market came swinging back. And, you know, I've done some presentations in the last few years about how the Federal Reserve was engaging in policies that were starting to move it perhaps towards irrelevance. But the Fed a year and a half ago or more asserted itself again back into the markets and has done so a couple times this year, as we just covered. And I think the Fed is actually going to play a very important role going forward based on its willingness to actually deviate from its congressional mandate. So just wanted to remind folks, I've been preaching the message for decades actually, but a couple of great examples in the last 2 years where you want to stick to your guns, stick to your plan, buy on the dips, sell on the rallies. Getting into a bit more detail about the last quarter, it's one of those where we have all green arrows. Every part of the market went up. And even though you did hear me say that it was the U.S. markets that dominated, you might notice it was emerging markets in the general sense that from the perspective of a U.S. investor had the biggest rally there at a 9.56% return. So not every part of the risk market, the 4 hours you see on the left there, had high single-digit returns, but it was still a very good quarter. And then fixed income just kind of held its own, and frankly, being above zero these days, just getting into positive territory is pretty good. You'll see the best quarter and the worst quarter listed there below. And of course, we're nowhere near the best, and we're not in negative territory, but always a reminder of what that can be, because if in the next 12 months we get another buying opportunity where we take a big, a dip in the markets, we don't want to be the folks that miss that chance to buy on a dip. We executed the last 2 times that happened, and we'll be ready to do it again if it happens. Looking at the U.S. stock market, and I'll remind you that this goes through the third quarter of 2020, what we see there is that all parts of the U.S. stock market were up. Large cap growth did the best, as it has done so many times before in the last decade, and small value did the worst. Now, I'm making the case in a presentation that was prepared a few weeks ago that I think that could be a little bit fragile going forward, and it really has to do with the nature of the Fed stimulus. I'll get into this. Turns out that's exactly what's happened. So events have actually confirmed what I'm going to talk about here in a bit. But so far this year, small cap value has not been the place to be. Large cap growth has been the place to be. And again, foreshadowing some future comments, that has started to reverse. You'll notice the U.S. market is 57% of the global equity markets now at the end of third quarter, which is just an amazingly high number that can't last forever. Looking at international developed stock markets, that's a lot of other economies that are more like ours, not emerging markets there. We saw most all parts of the market go up. Small cap actually did the best, but you'll see that there's a light gray bar and a dark gray bar. And the dark gray bar, fortunately, is the one that we all got. And that just adds in the currency effect. So the U.S. dollar fell, foreign currencies rose in general. So when we invested in all parts of those markets, we really invested in both the currencies and the equity markets. That's just the way it works unless you hedge that currency away. But this was a quarter where it very definitely benefited us, and I think there's rationale for why that trend may continue, meaning that we'll benefit from the currency translation, and that could increase the share of the global equity markets that we have in the foreign parts of the globe, and decrease the U.S. share. There's emerging markets, the part that really did the best, and while the very best part of that, the growth side as opposed to the value side, was up 14.15% from the perspective of a U.S. investor. So the currency effect added a little bit. There are some international emerging markets that actually hedge to the U.S. dollar, so sometimes you get less of a currency translation effect, positive or negative. But again, the falling dollar meant that the foreign currencies were appreciating, so we got some really nice returns there. Looking at REITs, sometimes REITs act like fixed income, sometimes REITs act like stocks. We do see the currency effects there a bit, in that REITs outside the U.S. did better than REITs inside the U.S. But there's also some other things going on. It's a very complex market right now, and it's something that I'm looking at on a daily basis, and here's what I mean. If the pandemic were to continue on for years and years and people are working from home, you can imagine what that would mean for the value of commercial real estate, office space in particular, but even retail space, strip malls and big malls, anchor malls, things like that. Warehousing is doing great, but there's all different parts of the real estate market. But you can understand why there's some stress. If we have some sense that the pandemic is going to be over sooner rather than later, then actually you might see a real rally here that outpaces the rest of the market. It's still an open question of, have employers learned that they can actually have a lot of folks working from home? They were forced to, and may be forced to for another 6 months, but is that going to permanently change the value of real estate? I'll insert here something that I just read in the last day that made me scratch my head a little bit, but I believe it was some strategists at Deutsche Bank that suggested globally there ought to be a 5% wage tax on anybody that works from home, just because they thought it would make sense from a policy standpoint for governments to force people back onto the road and back into offices. I'm still digesting that kind of a recommendation, but the idea was that the economy is built on people getting up and leaving the house every day to go to work, and we can't possibly have anything different from that, right? So you better start taxing people for working in the most efficient way. So anyway, a lot still to be decided about how the REIT markets are going to respond to the growing pandemic at the moment, but the good news that's sure to come a few months down the road. And now let's talk about our market outlook for the future. So I'm going to linger on this slide for just a second here. I've titled it the Federal Reserve Takeover, and I made a few comments already about what I mean by that, but let's just go through this for a second on this slide. There is an old saying, never fight the Fed when you're investing, meaning that if the Fed is trying to stimulate the markets, you want to go with that, and the Fed is doing everything it can to stimulate the markets. Again, back in the spring, whatever it takes, infinite money, those pledges are still in place. But it's the subsequent pledge, and this hit the news a few months ago, and CNBC and Bloomberg and all the business channels commented on it for a day or two, and then it just seemed to disappear, which is a bit disappointing because I actually think it is one of the bigger news events of the year. And just as a refresher, Congress has given the Federal Reserve 3 mandates. It's often framed as 2, but it's really 3. And one of those is keep long-term rates stable, keep inflation under control, and promote full employment. And what the Fed said was, we're going to focus on full employment. And we're going to really, just to paraphrase, do it with a vengeance. And we don't even care if we get inflation. We don't care if we get rising rates. We're going to focus on full employment. So they've reinterpreted their congressional mandate to essentially just put all of their chips behind one part of that, regardless of what happens with the other two. And they're going to do it for an extended period of time. Now, that is really, really big news to the financial markets, and we're going to talk a little bit about how that plays out as we go through the next set of slides here. So let's talk about the employment market. That's the one that they're going to focus on. So this is data through September. The two gray bars that you see and the new gray bar we're in right now are recessions. So you see the recession that we were in back in the 99-2000 range when the tech bubble burst. And of course, the Fed was stimulating things then. You see the Great Recession there, which is the gray bar in the middle. And then you see the recession that we're in right now. Well, the employment effect of the recession that we're in now has been pronounced. And so the Fed says this is the most important thing. Now, I'll add to that something that they said just yesterday. The Federal Reserve actually came out and said, this is the Fed chairman speaking, the economy as we know it may be over. The economy as we know it may be over. Now, sounds like bad news, and I'm going to tell you why. From the limited perspective of being an investor, it could actually be great news. Because what it means is they are going to do everything they can to stimulate the employment market for a long time. And their focus is on employment levels, but the policies, which have not fully cured the employment market. In fact, things may start to get worse now here for a few months because of what's happening with the virus cases. Could be the best news equity investors have heard in quite some time. Let's go to the next slide. If you look at inflation, inflation took a little bit of a wiggle, but has come right back. Remember, this is part of the congressional mandate for the Fed as well. But what the Fed said is, we're not going to worry if we get inflation. So inflation is still hovering around 1.5 to 2%. So now that means if you put your money in cash and earn, somewhere close to nothing, you're losing 1%, 1.5%, 2% to inflation. So cash is not a good place to be. And what the Fed has said is, cash isn't going to be a good place to be for years to come. So while their aim is to stimulate the employment market, what it means for investors is if you want to be safe, perfectly safe, you are going to be denied a return. Actually, you're not just going to be denied a return, you will be guaranteed a loss when you take inflation into account. So if in the aggregate, if collectively we all hear the message, if you don't take at least some risk, you're actually guaranteed to lose money when you look at what inflation's doing, then what normally happens is that in the aggregate, we all take a little bit more risk and the stock market booms. So the Fed has told us this is the equation. This is the math you're under. Be in cash and lose money, or go take some risk and make money, at least if everybody responds in the same way. So that's a really big deal, and the math is really that simple. Going to the next slide, let's look at fixed income rates. So this is a look back, but it's the vehicle for talking about the future. Now, in the top middle chart, that gray line is what we were looking at a year ago. The Fed had announced its policies to move rates lower, but it hadn't quite had the chance to do it. It's actually short-term rates are slightly higher than intermediate rates in that gray line at the top. So you've got this what we knew at the time and said at the time would be a temporary shape. The thing always straightens out. And then you look at us now, and we've even got in there where we were at 90 days ago, and you see now short-term rates at the bottom. Now, what the Fed has said is they're going to pin the short-term rate. They're going to pin it to zero, and it's going to be there, they think, for years to come. In fact, yesterday's announcement that the economy as we know it might be over means the Fed is probably looking at that being there for maybe even longer, maybe half a decade. We'll see. They also urged congressional action to stimulate the economy to try to get people back to work. Now, if this works, and the Fed is a very powerful institution, we'll see long-term rates move upwards. If long-term rates move upwards, because it's the market that sets the long-term rates, we could get a very steep yield curve. So long-term rates moving upwards is often a sign of inflation. The Fed will start to raise rates again. But they said, no, we're not going to do it. We're going to let the long-term rate go. We're going to let the long-term rate get very high even. We're going to let inflation really jump up. You know, our target's been 2% for years. It hasn't even really quite been at 2. It could go to 2. It could go to 2.5. It could go to 3. We don't care. We're going to keep the short-term rate pinned. So you could get a very steep yield curve with cash still earning nothing, because again, the market looks at long-term rates and says, hey, in a healthy growing economy, long-term rates need to be higher. So we could see it, the type of curve that we really haven't been able to observe in many, many years materialize here just in the next year or two. Now, one more quick comment about what that means for investors. It means if you're in cash, you're making nothing. If you buy longer-term bonds and rates are rising, well, you know, we know what happens. The bond index did well this past year because rates fell. If rates are rising in the intermediate and long end of the curve, you're actually going to have price decline. So there's no safe space in public market fixed income. I mean, we'll be safe in that we'll prevent most capital losses, but there's no great opportunity out there. So if you're in long term, you're worried about rates rising and killing the price of what you own. If you're short term, you're just, you know, stuck at low yield. So we need it for the capital preservation effect, at least to some degree, so that when we get volatility, we've immediately got a place to go to get resources to buy more equities. We're going to pile into it if we continue to get, you know, rallies, and we can take profits off the table. If you're distributing from your portfolio, you need it. But it really makes the case for other fixed income types of vehicles. And I'll just highlight that private fixed income is going to be a great alternative. And you're probably going to hear a lot about that from us even in the next month. If you can, you know, do well to make 2% in public fixed income over the next 5 years, 2% a year, which would match inflation perhaps, but maybe not. Or maybe you can make 10% in private fixed income. You know, what would you choose, 2 or 10? So if you can afford the illiquidity, if you've had a discussion with your personal wealth advisor, if you understand how it works and you qualify to invest in private instruments, you really just have to weigh safety and liquidity. It may be 2% or deal a little bit with the risk and the illiquidity that comes from that for a piece of your portfolio and go make 10 as an example. So the math for a lot of people is pretty clear, and that's why we're really going to be focusing on how to not have most of your assets stuck here in the next 5 years. Looking at fixed income markets around the world, there is a game being played, a competition playing out in front of our eyes that we often don't see. These are the 6 largest sovereign debt markets around the world, and they all look pretty similar now. You may notice that Germany in particular has a big part of what we call its yield curve below zero, and there have been calls to do that in the U.S., but I think just pinning the short-term rate at 0 is probably perfectly sufficient. Longer rates are all higher, which is a very good sign. It means really the markets expect all of those economies to grow. But the competition that I spoke of is who can keep their short-term rates lowest for longer. And what normally happens is if you have very low interest rates for a long period of time, your currency falls. We certainly saw that in the third quarter of 2020. The U.S. dollar fell. That means foreign currencies appreciated. That is also very good news for everyone on this call. When the foreign currencies appreciate, that means that all your foreign investments do particularly well. It's also good for the U.S. economy because when the U.S. dollar cheapens, we outcompete other countries in the global competition to export. Our falling currency makes our goods cheaper in the global marketplace. So what the Federal Reserve did, in addition to just announcing that being in cash was a bad idea, is it made a major play in this global competition to depreciate currencies. It told the currency markets, the U.S. is going to be at 0 for years to come. So the only logical response is for the U.S. dollar to fall and those foreign currencies to appreciate. So very good for U.S. businesses, very good for U.S. stocks, but actually great for your foreign stock holdings, because remember, you get a currency boost when foreign currencies do better than the U.S. currency. So there's no bad news in that anywhere, unless you're just going to pile in the cash and stay there, because that's the only place where there should be bad news. If anything we understand about economies turns out to actually be true. Looking at the foreign currency performance versus the U.S. dollar in the third quarter, to just drive the point home, these are all the other developed markets, and they all appreciated against the U.S. dollar. So if the U.S. dollar is the reference point there, every currency appreciated, even including the British pound, which is, don't forget the word Brexit, going through that, and with all of the stress that's creating on top of the pandemic, they still did better than the U.S. So go figure. If you look at emerging markets, a little bit more of a mixed bag there. You get some real issues that are country specific that emerge. They can tend to dominate things there. So a breadth of experiences, and there's actually, again, some currencies we don't bother to put up there because they're pegged to the dollar. But no real surprise that you might get Turkey and Russia and Argentina seeing some bad news. Again, that's more about the local politics and issues there than anything to do with what we've been talking about. And looking at commodities in the third quarter, well, all of a sudden we're seeing a commodity rush. Now, that is not enough to erase losses from earlier in the year, and I'm not sure we're at the point that we're going to want to start to pile into commodities. We've never had more than a token representation in commodities, but what's good news for commodities is often good news for stock markets, and what it does, if anything, is signal that there's some potential inflation to be had out there. So you see at the bottom of the list of commodities what's happened with the energy markets, and there's a real oversupply issue going on there. But if you look at everything else, hogs as well as the soybeans and all the industrial metals for sure, that's all quite positive for what the economy will do. And again, it signals that we're likely to be facing some inflation in the future. And as just a reminder, you all, what I'm saying here about this being the risk-on trade that we've had, if you look at world asset classes in the third quarter, we're seeing a trend that I think could continue. Look at what did the best, emerging markets, and emerging markets small cap. Look at what did the worst, at the very bottom, 1 month U.S. Treasury bills, otherwise known as cash. In a risk-on trade, the kind that the Federal Reserve is trying to promote, you get the riskiest asset class is doing the best, and the safest asset class is doing the worst. And that's what they're trying to do. They're trying to deprive you of return for being safe, compel you to take risk. And if everybody does that, then that's absolutely the place to be. So for all of the emotional stress that we might be under right now around the pandemic, around the election results, around all those types of things, this may not be the time to run for cover. This may actually be the time to make sure that you got a healthy dose of long-term diversified risk in your portfolio. Now, let's talk about a few other positive things. Let's look at retail sales. So we see the dip, we see the recovery. And in fact, if you were to put a ruler against your computer screen right now, you might even conclude that we've done more than just recover. We're actually higher. We're actually inflecting upwards. When anything changes, despite what the Deutsche Bank says, despite what the Federal Reserve says, here's all this change that must be bad. Change also creates innovation. Change creates new opportunities. Change creates innovation. Retail sales have gone upwards. And, what I know from personal experience as well as my reading is, if you want to go buy a boat, you live near a lake, you live near the ocean, you want to go buy a boat, good luck. All the boats have been sold. They can't make them fast enough. You want an all-terrain vehicle. You want a side-by-side. You want a motorcycle. You want a bicycle. You want roller skates. Good luck. Hoping nobody was planning to buy bicycles or roller skates for their kids or grandkids for Christmas. You can barely find them. The $200 pair of roller skates that you could buy, a year ago is $600 on eBay used if you can even find them. It's just crazy. So retail sales have more than recovered. more than recovered. And a lot of people just probably aren't aware of that. Let's talk about housing. Housing took a hit, took a dip. It's fully recovered. Supplies are light. There's building everywhere. Prices have recovered. If you're in the business of selling real estate, the best news you can find is somebody that's willing to sell that there's a new house on the market, because there's plenty of buyers out there. There's plenty of people with money. You know, there's literally, I think, $4.5 trillion floating around this economy in cash, just waiting to do something, waiting to buy stocks, waiting to buy houses, waiting to buy cars. We're just awash in cash, and the Fed's going to punish that cash every single day with a near zero return. So there's every reason to think that this is going to continue. So everybody I know that's working in the real estate market is as busy as they can be. Again, they could use a few more sellers, a little more supply on the market, but there's certainly plenty of buyers. And people are moving up. If there was a trend toward downsizing, I think that's largely gone away, because now people are working from home, expecting to work from home, at least in the near term, maybe thinking that they're going to have the opportunity to work from home as sort of the new permanent normal. So no bad news to be had there. So let's talk about another issue, and this really gets to the wrestling match that is playing out day to day in the markets right now. For those of you that like to watch the markets every single day, and I kind of hope most of you don't, but if you do, I do, you'll have noticed something. There's the so-called pandemic trade. You know, we're bringing this to you through Zoom, so there's lots of, stocks that have benefited from the pandemic and people working from home and so on, new disruptive technologies. Some of those have done kind of well, but now we've seen the emergence of a new trade. It's the old normal trade. It's the energy stocks. It's the industrial stocks. It's all the stuff that's maybe not new at all coming back. And growth is outperformed. What you see in this chart, and it's explained in the text, I'm not going to read all that. What you see in this chart is whether growth or value did better. So when you see those blue lines going down, that's growth stocks doing better. And we've had a lot of that in the last decade. What you see with the yellow lines going upwards is when value stocks do better. Well, on the whole, if you just look at the chart there, you'll see that value stocks do better by about 4.5% per year if you take a very long-term view. And that's why we have a value tilt to our investment approach. And so what we've seen in the last few weeks is the Fed stimulus is really being brought to bear, is days when the pandemic stocks don't do all that well, and you get this huge surge in value stocks. You get the long-term trend reasserting itself. And the point I would make is that when you have the Fed go into such great lengths to stimulate the economy with the promise to do that for years to come, you have that kind of stimulus lifting all boats. And so every day the market is wrestling. Is today the pandemic trade, or is today the Fed trade, where maybe the pandemic stocks are overpriced and you're going to see the resurgence of value stocks, or what we would just call cheaper stocks. I mean, in theory, if you buy a stock where you get $1 of earnings, but you pay less to buy $1 of earnings, that's a value stock. That would serve you best in the long run. In the long run history is that, of course, it has. So if we see that trade reemerging, and there's been multiple days where it has in a major way, then we could see value stocks significantly outperforming here in the future over the next, let's say, half a decade, while the Fed has its foot on the gas. So a little bit of disclosure there, and go to the next slide and start to wrap things up. So this is a funny meme going around the internet. This product contains nuts as the sign, and it's worth a chuckle because a grocer was required to or felt compelled to label the nuts to say that it contains that. So we all laugh at that. Is that government overreach? Is that regulation? Is that just nonsense? The point is that it's self-evident. It's self-evident. So I've got this up there because I just want to remind folks that when you're thinking about the stock market, think of it like that sign. Do I need to put up a sign that says the stock market could be volatile? The market contains stocks. Stocks go up and down. If you have memories of a time to invest, when you thought it was safe and it just seemed easy and safe and you weren't scared, I'll suggest those might be false memories. It wasn't the right conclusion to take. We should always approach the stock market as something that contains risk. And we don't say risk in the sense that the stock market will end. We say risk in the sense that it goes up and down. But as we've seen over the last couple of years, a volatile stock market can be a very good thing. A chance to buy at prices cheaper than they are today would be welcomed by many people. I love a volatile stock market. I love it when we get a year where we can do some buy low, sell high throughout the year, because that increases your return. So we have some proprietary research on when to buy on the dips, when to sell on the rallies, but volatility is not a bad thing. So being in the stock market shouldn't require that you believe it's going to be calm. If anyone's got the perspective, well, and of course we were looking at this a few weeks ago when we were first doing this before the election, I'm going to wait till things settle down. I'm going to wait till the future is more certain. I'm going to wait till it all looks easy. If it does to you, it never should. The stock market is always volatile. The market always contains these things that can go up and down in a big way every day. So you can't wait until it's calm to be a stock market investor. You actually want to be an investor while it's volatile. So don't wait, and definitely don't sit in cash. The past year punished doubters again. So if our long-term charts don't convince you, it hasn't yet hopefully faded from memory what happened this spring. It might have faded from memory what was happening at the end of 2018, where we took the big dip there. But how many times do we have to witness it to where if you doubt that your long-term plan is the right place to be, that you got punished a little bit for that. And then lastly, as I mentioned already, value should eventually beat growth. It has in the long run, and things are really lining up for us to potentially witness value beating growth in a very meaningful way for the next half a decade.